Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from 10 Holdings Inc. and let's just say it involves some creative accounting that might leave you scratching your head. Is it a deal or a scheme? Let's find out. This report is all about how 10 Holdings is settling some debts, but the way they're doing it is a bit unusual and might raise some eyebrows for investors. They're basically paying off all debts with new company stock. What does that really mean for the company's future? We'll break down the key points. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below, so join us there to discuss this and other company filings. This report is called a Form 8K, which is like a company's way of shouting, hey, something important happened. 10 Holdings filed this one because they made a deal to settle some debts and issue stock. That's what we're going to unpack today. The report is dated April 30, 2025, so it's relatively recent. That's when the agreement in the report went into effect. 10 Holdings Inc., which is the company we are talking about today, is based in Nevada. Their main office is in Langhorne, Pennsylvania. Their phone number, including area code, is 1.809-980-9598. Let's get to the meat of the matter. Item 1.01 is where companies talk about big deals they've made. In this case, 10 Holdings entered into a settlement agreement with a company called Sunpeak Holdings Corporation, or SHC for short. Basically, 10 Holdings owed some money, about $4 to $91 million to various creditors. Instead of paying cash, Sunpeak Holdings is stepping in to buy up these debts, these outstanding payables. Here's where it gets interesting. Sunpeak is not buying those debts out of the goodness of their heart, and 10 Holdings is not going to pay them cash. They are instead going to settle those debts with shares of 10 Holdings stock. Think of it like paying your credit card bill with Monopoly money, maybe not exactly the same, but close enough. The number of shares will be based on the stock price on April 23, 2020. On top of that, 10 Holdings is also giving Sunpeak 175,000 shares as a settlement fee, completely free, just for making this deal. These shares are freely trading, which means Sunpeak can sell them right away. All of this is happening under something called Section 310 of the Securities Act. Basically, it's a legal loophole that lets companies issue stock without the usual registration process, as long as a court approves the deal. And in this case, a court in Florida did approve the settlement agreement and the stock issuance on April 30, 2025. That makes everything legal and binding. Here is where it gets even more interesting. There is something in the agreement to make sure that Sunpeak doesn't own too much of 10 Holdings. Sunpeak agreed they won't own more than 4.99% of the company's stock at any time. But there's a catch. If 10 Holdings stock price drops below $0.25 per share, or if the average trading volume gets too low, the company is considered in default. It's a violation on the agreement. Moving on to item 3.02. This is just a technical section that basically says, hey, we sold some stock without registering it, referring back to the stock issued to Sunpeak. If you want to read the full legal details, you can check out Exhibit 99.1, which is the actual settlement agreement. So what does all of this mean? Basically, 10 Holdings is using its own stock to pay off debts. This can be good in the short term because it gets rid of debt without using cash. But it also means that existing shareholders now own a smaller piece of the pie because there are more shares out there, which can lower the value of each share. This is also called dilution. The fact that Sunpeak can't own more than 4.99% of the company could provide protection to the existing stockholders. As the agreement becomes broken, if they own more than 4.99% of the company, could provide protection to the existing stockholders as the agreement becomes broken if they own more fear. Additionally, it puts pressure on the company to increase its stock price and trading volume to avoid default. Now, let's step back and look at the big picture. 10 Holdings is using a somewhat risky strategy to deal with its debts. On one hand, it's avoiding a cash crunch. On the other hand, it's betting on its stock price not falling too low, and they need to increase trading volume so that the agreement doesn't get broken. If the company can turn things around and grow its business, this could work out well, but if things get worse, it could create even more problems. So, what's the final verdict? 10 Holdings is in a tough spot and they're trying to get creative with their finances. It's a high risk, high reward situation. Investors need to watch closely to see if the company can deliver on its promises and keep its stock price above that critical $0.25 mark. Alright, that's our breakdown of 10 Holdings' latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.